First of all, Paolo Cemento, Head of Transactional Services at Cushman & Wakefield, and accompanied by Augusto Lobo, Head of Capital Markets at JLL. After their presentation, we will be welcoming back Richard Betts again to moderate an investor roundtable, followed by another woo clap question, which is, of course, your opportunity to participate with your opinion. So, gentlemen, over to you. Thank you very much.
So, good morning, everyone, and thank you for entering this room, having such a great weather outside to listen to our presentation. We'll be speaking about much more than living, so we'll be speaking about other asset classes. Portugal is a turning point in investment, so what we'll discuss is the current opportunities that we are seeing on the market. So, Paulo Sarmento from Cushman and myself will give a presentation of where the market is regarding investment, and we'll do a deep dive in some of the main asset classes.
Thank you very much, Augusto. So we have a lot of ground to cover. We really need to hurry, so we'll do this the Benfica style, a Benfica. We don't have a lot of time, so let's get right on to it. We will start by speaking a little bit about property investment in general. We will then focus on the individual asset classes that we will cover. A final word about debt financing, and then a wrap-up, hopefully helping the panel answer the questions, where are the opportunities?
So, starting with the global investment picture, I mean, Portugal was not an exception in 2023 when we hit some record lows in investment volume, but we had a very strong rebound in 2024, mainly driven by the retail sector. This momentum is keeping up in 2025. We had a very strong first half of the year with over 1.2 billion euros of transactions, and we expect to finish the year slightly above last year's record levels of investment.
If we look at the breakdown of how this investment is spread across asset classes, we will see a pattern that is very similar to what we saw last year. So retail dominating, of course, not as high as transaction volume as last year, because there's not an infinite number of shopping centers to trade, but the main asset class is going to be retail, followed by hotels. And again, as Augusto said, we'll probably end the year slightly above where we ended up last year.
And on yields, what we are witnessing, of course, is that yields are following the global investor appetite for each sector. Portugal is quite stable regarding yield evolution over the years, and after a period of some stability in yields, we are starting to witness some yield compression in sectors such as hospitality and also and especially in high street retail, driven by a very strong demand by family offices.
How do we compare against other European countries? Quite well, I would argue. If you look at the total return as measured by the MSCI 10-year total return index, Portugal actually compares quite well and was able to achieve consistent returns. What is a very, very interesting second side of this is that apart from having good returns, we also have a very low levels of volatility compared with the countries that have the highest returns. If you look at the graph, you'll see that volatility measured by the standard deviation in Portugal has been quite low. So we are both providing good returns and low volatility. I would say this makes us a very good investment haven.
Now, I'm starting with our first deep dive on a sector. We are starting with the living sector, so including PBSA, senior living, healthcare, and multifamily. This is a sector where Portugal has somewhat of a low investment volume compared to other sectors, but it's a sector that has been clearly dominated by one-off large transactions during the years. The main subsector or asset class that traded during these last years was mainly multifamily, but PBSA is clearly starting to be a very strong and dominant subsector in the living sector.
Probably worth saying that the reason why multifamily has dominated is basically grounded on a few very large PRS transactions. We don't see a lot of regular deal flow. We have seen, however, very large PRS transactions accounting for this number. If we look at the subsectors within living, and starting with PBSA, clearly a rising star, well, the numbers are actually quite easy to understand. Just look at the left-hand side of the graph. This shows the provision rate, that means the number of beds per 1,000 students in higher education. The European average is 12%. Just see where we are in Porto and in Lisbon. We have come a long way, but we are still very far from the European average, especially in Lisbon. So this can only mean that there's ample room for further development, further growth of supply, and certainly rental growth.
Besides the provision rate that Paulo mentioned, I mean, the attractiveness of Portugal also for international students is driving a very strong and sustainable growth in rents in PBSA schemes. When we check the last 4 academic years, rents have grown by over 50%. And as you can see, we have an average growth rate of about 11 to 12%. So that means that we also have a very sustainable rental growth that is also driving a strong appetite by investors.
So this was for PBSA. We now move on to senior. That's not a very significant category in terms of investment. And actually, we don't have a lot of statistics on senior living. We do have statistics on nursing homes in particular. In that regard, Portugal compares sort of in line with European averages. What is interesting is that what Augusto will mention now is how the breakdown of this supply is across the different owners.
Yeah, from an operation point of view, we have a very different picture that you can see in other markets. So in Portugal, the market is dominated mainly by non-profit operations that are government subsidized, with only a small share of private sector operations, with 25%. This means there is a very important room for growth in the private nursing homes, especially taking into account that we are a very attractive country for international retirees. And also, when you look at the demographics, the demand will increase with also the increase of longevity.
Now we will move on to multifamily or PRS, whatever you want to call it, there's terms for this. We have mentioned that the investment volume in Portugal in this asset class is not as high as it is in other European countries. This is a sector that consistently ranks #1 or #2 in terms of attractiveness of investment. We in Portugal have not been so lucky. The fact is we have had a few PRS transactions that have made multifamily the dominant sub-asset class within living. Having said this, we haven't had any build-to-rent transactions. There's one that was just exchanged in Porto very recently, hopefully the first of many. But again, multifamily as a proportion of property investment in Portugal is very far from where we like it to be.
Well, one of the reasons why we don't have that strong BTR or flex living sectors right now is that returns in BTS and build-to-sell are extremely high, mainly due to a very strong imbalance between supply and demand in the residential sector in Portugal. When you check price evolution in Portugal, we have more than doubled since 2015, and prices are growing at much higher rate than in the rest of European countries. However, it is true that we also feel the demand of diverse occupational solutions, and that is driving a strong also pipeline of potential flex living assets and also some potential BTR transactions that will bring much more appetite to the market in the next few years.
So if we look at the trends overall in the living sector in its several subsectors, let's start with PBSA. The numbers are, I mean, there's no doubt about them. There's ample room for more development and for rental growth. All of this based on a very low provision rate and a lack of balance between supply and demand. A lot of appetite from investors driving pressure on yields. Senior living, we see investment picking up, and what we probably will see is a phenomenon that happened in other European jurisdictions, which is a concentration of ownership of the operations. There are a lot of sort of small artisanal mom-and-pop nursing homes in Portugal. They will be acquired by larger operators. These operators will probably be able to concede long leases, and this will fuel the investment market. In terms of healthcare, we see a lot of dynamics from local operators expanding their footprint in Portugal, not necessarily hospitals, but certainly clinics. A lot of these operators have the so-called asset-light strategies. They don't want to own their property, they want to lease their property, they are willing to give long leases, and this will, of course, fuel investment in this asset class. And finally, in multifamily, we hope to see it grow. I think we need some important tax changes on VAT and construction costs if we really want to see this build-to-rent sector to thrive. Until then, it will basically be a market of build-to-sell. This market will, of course, be fueled by tremendous growth and because of the imbalance between supply and demand.
So moving on to offices, which sometimes reminds me a lot of what we heard in the past about retail, because it's almost the same story. So on offices, of course, we haven't been an exception from the investor sentiment that we saw in other markets. So we had a steep fall of investment volumes in offices. However, over these last 2 years, we are seeing an increase in the number of transactions, mainly by local players that have maybe a stronger knowledge of the local market dynamics. And also, when we check the average deal size, this is one of the main drivers of this drop in investment volumes that we saw in the past. But in the last 2 years, we are seeing already some recovery. So in 2024, we closed at 19 million euro per deal, which compares against 44 million in 2020. And the first half of the year, we closed at 23 million. And checking the potential pipeline until the end of the year, we'll have a much higher amount per deal in the year of 2025.
All this optimism out of office investment is grounded on very solid occupational fundamentals. We'll probably end this year with a gross take-up in Lisbon of around 170,000 meters, roughly just slightly below your R6-year average of roughly 190,000 meters. Last year was an exuberant year, this year not so much, but we are in the market, we are in the trenches every day, we deal with occupiers every day. There's a lot of latent demand. We also have to understand that the stock we have of grade A assets is limited and the vacancy levels are very low. So in a context you don't have a lot of grade A stock, you don't have a lot of vacancy, it's hard to have very high take-up numbers. But the numbers are quite interesting and the dynamics, the occupational dynamics are still there.
So focusing on vacancy, as Paulo mentioned, I mean, we are well below the average of other major cities. But this figure also is brings you to a bit of a mistake, because if you start to scratch the surface and to check which are the assets that don't have any need for a deep refurbishment or strong capex investment to be attractive to today's tenants, you can see that grade A, high-quality offices are very limited right now in availability. Also, when you look at the pipeline under constructions, it's also extremely limited, accounting for about 1 year of average take-up. That also explains why 44% of this pipeline is already preoccupied.
In terms of prime rents and yields, significant story of success until now, but it's still going forward. We have seen significant rental growth since 2018 in our markets, 45% in Lisbon, 24% in Porto. This is due to the lack of balance between grade A supply and demand. If you look at our prime rents in Lisbon and Porto, respectively 29 and 21 euros, and by the way, by year-end, these numbers will probably change, you will see that we are still very far from our European counterparts. Just look at the rents in Madrid and Barcelona. It's a good example. Our yields are stable, hovering around the 5% mark, but we will probably see some compression already next year.
So a brief overview of the trends that we are seeing on the office market. Well, first of all, I think that nobody still speaks about the challenge of working from home. What we do speak is about the need to attract and retain talent. That's a key issue in how you structure an office asset right now. So office is being much more a service and much closer to an hotel than it was in the past. Also, the flex share of space and flex offices are already, I would say, business as usual. So it's a key part of any current modern office complex. We have a constraint in supply. We don't have that much space available right now, grade A prime CBD options. So that means that fundamentals remain very strong. So we should expect, as we saw in other sectors, like for example retail, that the wave of capital will start to grow and people will start really to value a solid asset class with very strong fundamentals.
Right, this closes the chapter for offices. Let's move on to industrial and logistics. Traditionally a category that hasn't received a lot of investment in Portugal. This is certainly not due to lack of investor appetite for Portuguese logistics. It's just we don't have enough grade A stock. We actually had a bit of a drought in development activity all the way until 2017-18. That has completely changed. We now have both Portuguese and international developers producing significant amounts of grade A stock. So this will probably filter into the investment market later on and will drive investment values up. We hope to end the year around 150 million euros of investment. This number is a far cry from other European countries, but again, we need that stock to reach the market in order for the investment volume numbers to start to rise.
So when we look at demand, at the take-up, we can see that we are having year after year of very strong figures in take-up. And this take-up is not only made up of organic expansion of tenants, but also by a change in the quality of assets the tenants are demanding. So there are tenants that are moving to higher quality assets. Also nearshoring, which is a key trend that we are witnessing right now, of course, brings also some new demand to the markets. When we look at the pipeline and the construction, the main and the key indicator that we can check is that we have about half a year of supply in pipeline right now when we compare to the average take-up that we have seen over this year. And that's why it is easy to understand that over 87% of this is already preoccupied.
Again, prime rents and yields, a situation which is not very dissimilar to the one we saw in offices. Significant rental growth all the way to now. We are now around 5.5 euros both in Lisbon and Porto, but still very far from our European counterparts. Just look at Madrid and Barcelona for the sake of comparison. In terms of prime yields, we are at 5.5 in Lisbon, 6 in Porto. We also think these numbers will come in as new quality stock reaches the market with long leases and good occupiers.
Now, talking about the new kid on the block, data centers, Portugal has some exceptional fundamentals in data centers. We have a strategic geographical location as anchor points of transatlantic cables. We have green energy. We have security and stability, which are also extremely important right now. And we have a very good pool of talents. However, when we see the IT load currently in operation is still quite small at 29 megawatts, with a pipeline of only 46 megawatts and a very low vacancy of 2.3%. And that also explains why we have over 1.2 giga of planned expansion in the future, mainly located in the Sines area.
So wrapping up the industrial and logistics sector, which are the trends? Well, a continued demand for grade A stock. This is evident, as Augusto mentioned, probably driving a lot of existing stock obsolete, and there will be a massive movement of tenants from obsolete to new stock, and this will of course drive rental growth. There is ample room for rental growth. Rents are amongst the lowest in Europe, so there's room for that. We expect core investors to finally have suitable investment targets and finally drop up these investment volumes in logistics. Having said this, some of the main developers actually busy in Portugal delivering grade A logistics, they like to hold on to their real estate. They are not necessarily merchant developers. So a lot of that stake that is actually leasing now will not necessarily trade in the investment market. And Augusto already mentioned the reasons why in infrastructure cables, plenty of green energy. We expect the data center business in Portugal to develop quite significantly.
So moving on to a sector where we clearly have something really strong to say as a country. I mean, Portugal has some of the most productive and some of the most dominant retail schemes in Europe. So we are a country of shopping centers, of big and very dominant shopping centers. Of course, the wave of doubts about the sustainability of physical retail hit Portugal as it hit other countries. And we saw a reduction in volumes mainly after COVID. But then the wave of appetite and interest for retail and mainly for shopping centers came back strongly in 2024 with over 1.2 billion euro of transactions. What we are witnessing is that the demand is there, the capital is there. There are a number of investors trying to buy assets in Portugal. We expect to close the year slightly below last year's total volume, but that's mainly because we have a lack of tradable product right now on the market.
This is actually easy to see in the following graph. This basically tries to represent the amount of shopping center investment within the context of retail investment. And we saw, of course, a peak in 2020 where shopping centers accounted for 83% of total retail investment. This, of course, thanks to the Sierra Prime transaction, the major crown jewels of the Sinai Sierra schemes that change hands. massive drop the next year, actually massive drop in investment volume and in the percentage of retail investment volume which was secured by shopping centers. And since then, we've been gradually growing up. Again, if we had more shopping centers to trade, this figure would even be higher, but we expect to end this year in a situation where 2/3 of total investment volume are done through shopping centers.
Also, the beauty of this sector, and it was mentioned in one of the panels before, on the shopping center panel, is that we can really measure the fundamentals of the sector. We can check the sales of our tenants. And what sales are saying is that we are growing at almost 6% real volumes year-to-date to June. And also a key indicator is the fact that this growth is across the board. It's food retail, but it is also non-food retail that is growing. When we look specifically at shopping centers, I will say that the main takeaway is the increase in conversion ratio. So almost with only a slight increase in visitors, we are having a very strong growth in sales. And of course, this drives the NOI, which at the end of the day, it is what investors are interested about.
Right. Speaking about prime rents and yields, we now, of course, turn to high street retail, where we have the highest rents. A lot of pressure from luxury retailers recently driving high street rents all the way to 100 euros per month. This is still a far cry. Just look at the rents in Madrid, Barcelona, around 250 euros. So luxury retailers very happy to pay 140 in Portugal. Interestingly, in terms of yields, we compare quite well with our European counterparts. And the reason for this is that most high street retail deals in Portugal are small ticket sizes, so well within the reach of family offices that can pay, of course, very aggressive yields.
So doing a quick wrap-up on the retail sector. Well, as we have seen, the shopping center performance is doing well, so strong growth in NOI, strong growth in occupancy. That means that also the shopping center investment wave has arrived to Portugal. So the south of Europe is a key destination right now for any shopping center investment. Just to give an idea, in the first half of the year, Portugal and Spain combined together were the #1 investment market in retail in continental Europe. So there is this wave of investment, but there is a lack of assets on the market. So that will limit the number and the volume of transactions. On the other hand, we are also witnessing a strong increase in demand by occupiers for retail parks. And that means that as we have a very small stock of retail parks, we are seeing an increase in development of new retail park assets. And finally, as Paulo mentioned on high street, I mean, the number of high streets that we have in Portugal is limited. We know where they are, we know the sizes of the stores, we know the demand that we have from tenants and from luxury brands. So it's a market that is performing extremely well, especially due to the demand also of Iberian family offices wanting to acquire these assets. Mm-hmm.
Quick word on debt financing, just before we go. Not really much to say here, except that it's certainly not due to lack of bank financing that we don't have more real estate deals in Portugal. The market is quite particular. It's dominated by a handful of domestic players. I call them domestic because they are originally Portuguese banks. Most of them are in the hands of foreign players now, but they operate as domestic banks. They are really open for business and willing to take risks that in a lot of other jurisdictions, traditional senior lenders wouldn't take. And this is the reason why we see a lot of them, a significant market share still taken by senior lenders here, and not so much presence of alternative lenders as you would see in other markets. There is a third way to finance property investment deals or property investment companies, which is issuing debt in the capital markets. We haven't seen that happen in Portugal. That has happened in Spain. Merlin does it frequently. Other operators have sporadically done this. We haven't seen this done in Portugal. We don't see this happening anytime soon. So just to wrap up, and I promise this is our final slide. If we have to go back and sort of try and help the panel address the question, where are the opportunities in terms of the main trends? Well, certainly pigs can fly. This is the major trend that we can focus on. We all remember where we were in 2010 all the way to 2014. Just think of where we were then and where we are now. Iberia is clearly the flavor of the month, and there's a good reason for that. Economics are good, the countries are stable, the occupational markets are very strong. So the idea behind the investment in Portugal and Spain is quite interesting. In terms of the sub-asset classes, so built-to-rent still dragging, we would love to see more transactions, but I think we need a major tax change in construction VAT for that to happen. PBSA and senior, of course, on the rise, still starting with a low base, especially senior, but clearly on the rise. The shopping center investment wave is definitely here. There's no doubt about it. If we had more assets to trade, we would certainly trade more. We will see more grade A logistics stock arriving to the market. Not all of it will trade, but part of that will trade, and that will drive investment volumes up. In hospitality, we didn't touch on hospitality in this session because that was the subject of our friends Iberian and Savills yesterday. But there's a couple of things we can say about this. It used to be an alternative asset class. It is by no means an alternative asset class anymore. Portugal used to be an alternative market. It's certainly not an alternative market. It is a completely consolidated market. So this is the story we had to tell you. On behalf of Augusto, JLL, myself, Cushman Wakefield, thank you very much for bearing with us. It was a pleasure. Hope you enjoyed it. And over to you, Drecha.